All right. I appreciate your time and I appreciate David for the invite to be here with you guys. My name is Brian. I'm the head strategist for Equity Sciences. And today is just a brief introduction into, into our company and the products and services that we seek to offer. And so, everything, all of our research that we really found stems from, comes from trying to diversify the factors that produce outcome. Within our years of research, we really found a commonality with how other concepts, models, et cetera, fail. And time again, really, it comes back to outcome being dependent on a perspective of singularity, whether it's a single market environment, a single condition, a single variation of of value or alpha. And so actually one commonality that that every portfolio manager or institution deploy, no matter if it's traditional or counter trend, trending, market timing, it doesn't matter. Every institution or portfolio manager deploys diversification, right, as a means to improve outcome consistency or mitigate various risks. And so, but we tend to take that kind of light years beyond the traditional allocation perspective and apply it on a per strategy, per asset level. And what I mean by that is so that each asset's outcome is not dependent on a single type of alpha or single strategic model. And so every structure that we or every product that we design allows for multiple entries per position. And so before I get started, let me read off our disclaimer. Historical performance, whether live or simulated, may not be indicative of future results. Trading equities, futures, and FX carries a high degree of risk, may not be suitable for every investor. Investors should only choose to invest funds they can afford to lose without negatively impacting lifestyle. We do not guarantee nor claim our products will perform positively or reflect their historical results. In fact, there can be significant differences between historical and future results. Please consult your investment professional before selecting any trading or investing product to ensure it meets your investment objectives and risk tolerances. All results and data displayed are historically simulated, not live real. Everything reviewed and discussed is my personal opinion, not to be considered investment advice, nor solicitation of any individual product, service, and/or equity. All right. So conceptually, everything starts with market classification for us. And so a very, general example of that, I guess you could say, is even though that we really don't use these forms of analytics, but the theme is the same. And so, these are just some common analytic methods, that you're probably familiar with. But basically, we classify the market into 64 different repetitive environments. And then what we do is we design a strategic model or a source of alpha for each one of those classifications. And so that is the main, I guess you could say, foundation or framework that every strategy or product that we design is really built upon. And it gives us the ability to really gauge the full picture of the market by looking at multiple frequencies of analytics, such as various links on various types. So we want to look at and break things down, not just from the analytic efficiency perspective, from analyzing which forms of analytics provide the most predictive power, which forms of analytics have the best work, the best lag, and then also which work well together. And so really what we want to do is form a full picture of the market, such as short-term, long-term movements, as well as directional movements and volatility, and where we are within those sequences. And so when you deploy market classification, again, this is the basic framework of it. You can then take that another step beyond and determine, predictive analytics from each classification, from how long the classifications occur, from the depth or distance of movement, what was the effect of that classification. And then historically you can identify, well, if certain condition, let's say classification 5 occurs for a certain amount of time for a certain amount of distance, there's an increased probability that maybe classification 12 may be next. So models that you have designed for classification 12, you can apply a slightly heavier weighting mechanism to those models. And so it gives us the ability to employ both reactive and predictive processes within a single structure. And so but the overall goal of equity sciences is to bring, advanced, intelligent, quantitative solutions to be deployed in a very simple and direct manner, and for our products and services to be able to serve a very wide and ranging group of preferences, as we realize that they come in many shapes and forms. And for instance, our purchase products can be plug and play. You can deploy the variant that we deliver to you. However, you also have access to the inputs and code as well. And so, for those who want to be a little bit more involved, can apply to other markets, can customize, tune, backtest, optimize, etc., as you wish. And so, our products primarily break down into two categories, which are fully developed quantitative strategies and/or allocation models. Our allocation models are designed maybe for clients that have slightly different objectives. Maybe they don't have as much time to allocate, or maybe they have more long-term position hold objectives, and so they're a little less involved. And so, but even our quantitative strategies deploy intelligent allocation models, and they're kind of like the full package, but they're designed for slightly different preferences, objectives, etc. And so I'll display some of that here in just a moment. And so our quantitative strategies, again, deploy market classification, and the main systematic structure, again, market classification, and then we have our allocation, money, and risk management overlays. Now, how we design everything is with actually the expectation, really, that our entry logic, our sources of alpha or value, is going to fail at some point, right? Due to the somewhat stochastic level of randomness, price characteristic evolution, the name, pick your tune, whatever the reason there. At some point, your entry logic, the alpha correlation is going to fall out of favor with the market. And so really, every structure that we implement is designed to really mitigate the many of the associated risks with quantitative strategies. And so while this may seem complex in nature and maybe increase the risk of overfitting, et cetera, actually it's quite the opposite. Even though that you have the framework to exploit specificity, nothing is dependent. Outcome is not dependent on any single one of those environments, conditions, source models, etc. And so with that, basically we strip down all the intelligent adaptive entry logic or exit logic, and we say, okay, if all of that fails, and the only thing left really is our allocation model, which dynamically identifies the optimal percent allocation on a per entry, per position basis. And that uses a combination of market classification as well as multifactorial value calculations. And so if everything is stripped away, will the allocation model in and of itself nurture positive outcome, right? So if every bit of intellect is really taken away, what's left is still a model, an underlying structure that will nurture positive outcome within a per position basis, right? And so that's really how we designed the systematic structure. And so then you have the initial entry logic, conditions, dynamic values. We don't want the positive outcome of the strategy to be based or justified by allowing additional entries or an intelligent allocation model. We want the initial entry to be as efficient as possible. Obviously, we're not going to always be correct. We're not always going to be accurate, but in that instance, so we test the initial entry first. And so again, the additional entries and the allocation model are two structures that act somewhat like safety net structures within the entire systematic strategy. And all of our quantitative strategies deploys this same structure. And so then we have our model condition specific exit model. So each individual classification or each model that we design has its own set of exit logic. And then number 6 is general condition exit model overlays. So then we have some general exit models that we overlay that can execute no matter which model is active at the time. And then we have internal efficiency analytics and feedback loops. And this is, this is really important to give the strategy the ability to analyze how efficient it was on an entry or exit basis, identify the condition or the model that activated that entry, the condition before, during, and after, and being able to feed that back in for a constant pressure, I guess you could say, of improvement. And so an example of a fully developed quantitative model would be our SPY. This is, again, our SPY outcome product. And here is a simulated, hypothetical result of that model applied over the past 20 years or so, right? This model starts with 100K. However, you can use much less than that, but that's just what, when I'm testing or designing a model, always start with 100K, and that's just a round figure that I always tend to start with within the development process. But technically, you could go as low as 10 or 15 on this product, while still being able to fully exploit all the entries that it deploys and all the models, etc. And so, again, a visual basic example of market classification is if you were just looking at a chart, right? This is kind of a visual representation of what market classification is. So, here's some basic, moving averages, exponential moving averages. I think we got a 20, a 50, and a 200, right? Very commonly used. We necessarily don't use these, but this is, again, just a basic example. And so these indications, the top 3 here, are representative of where close is relative to that average price, and then the percent of that on a scale, right? So, where we are on that distance, right? The difference between close minus average 20 or average 50 or 200. And so what's the scale of that on a 0 to 100% basis, right? And so here is the volatility. So the theme is very similar to what we use. It's just the analytics are different. So, here's a volatility indication, and here's directional price movement, right? So downward movement occurs at a very a different pattern than what upward movement occurs at. So you want to look at that at a different frequency. Now that, again, the theme is the same here. However, the analytics are slightly different. So before we include an analytic structure within market classification, again, we research to find which have the most predictive power, which are best and better environments to identify a higher probability of a pullback or a reverting condition, et cetera. And so, before we include that, but every strategy is designed for optimal versatility. So for those who choose to purchase a product and deploy it on your own trading platform, you have access to change how you're classifying the market itself. So you have full access to all the inputs, customization, et cetera. And so, our products are really offered in 2 ways. One, as a purchase product that you purchase, you have access to when we help throughout the entire familiarization and setup process. And then you can deploy, again, the plug and play, you can deploy the variant that we deliver to you, and or you can further customize it to very specific preferences, optimize, back tests, et cetera, or even apply to other markets. Or the signal services. And the signal services, again, are for maybe someone that doesn't have as much time. They're not staring in front of a computer all day. Then maybe they're just looking for signals at certain times of the day. And our signal services really work toward meeting those clients' needs. And so those are really sent out via email. You get the entry logic, or the entry targets, exit targets, and allocation percentage, and those are updated after the close of every day. So that way you just look at it once a day. You can program your entries, your exits, set it, forget it, and type of move on with each market, or with each package that you choose to move forward. So we offer, stocks, ETFs, et cetera. And so again, here's our SPY outcome. You can see how it performs in multiple environments. Again, here's 2020, and as you can see, the reason for multiple entries, right? Other than being able to diversify alpha sources, right? Because you can do that technically with a single entry, but when you allow multiple entries, it creates the framework to and fuse multifaceted or multi-layered intellect within the allocation side. And so it gives us the ability to identify what is the optimal allocation on a per entry, per position, per condition basis, right? So what is the optimal allocation percentage on a per entry, per position, per condition, and per model basis? And so when you then combine that with our dynamic calculations, and so one example of a dynamic calculation that we look at, other than using a kind of a weighted combination of market classification, is just measuring close from the highest high plus open minus close, right? Very simple calculation, right? And it can give you, and then you rate that out on a 100%, scale. And then we use that to determine what percent is allocated on a per condition basis. So that's one of the dynamic calculations that we can use in combination with logic that's more set in nature based on the optimal values that we found historically in our research, for each model individually, per condition, again, per classification, et cetera. And so, but again, I'm diving into a little specifics here, but the joy of these products is that you don't, the clients don't have to dive into the specifics. It can be plug and play. We really work hard to deliver a streamlined product that really serves a really wide breadth of preferences. For those who really want to dive into specifics, you have that functionality, you have the ability to do so. For clients who just kind of want a packaged pre-delivered, kind of product that you can deploy, you have that option as well. And so again, we really understand that products need to be extremely versatile in today's serving today's more up to date clientele. And so here again is another quantitative strategy. It's applied to XLU. Again, we also use multiple data streams, for correlation analytics in some of our concepts. And so that's the reason why you see some multiple data streams here. Here's a simulated example of, hypothetical example of XLU over the past 20 years or so. Again, it starts with 100K. And another reason for trade frequency, as you can see, the trade frequency is very high, as it is with SPY. And that increases the the data points for us to improve the efficiency feedback loops, but also to reduce the risk of overfitting, et cetera. But you can also more quickly identify when something is not performing as it should, or it's performing well. It goes both ways. And so we really like healthy trade frequency. When you combine healthy trade frequency with accuracy, and then you wrap that within a compounding allocation structure. So, you're compounding per trade profitability. So each trade, the amount of profit that's made compounds back into the allocation calculation. And so that really nurtures, a rate of growth that doesn't really depend on obtaining a high percent profit percentage on a per trade basis, right? You can be in and out kind of quickly. And so an example of this would be, the percent time in market. Again, this model hypothetically simulated approximately 84%. And then the percent time in market, let me see, where is that? It's approximately 53%. So the percent time in market is approximately 53%. And then, historically, the buy and hold return was 501, and the return on this model historically in the same time period is, 2100%. And so here is the, another quantitative strategy applied to XLP, which is our staples. and hypothetical simulated. And again, you see a common theme with all of our products. One, we always allow multiple entries. Two, we have decent trade frequency and we exploit multiple market environments. We don't want outcome to be dependent on any single condition. Now you're obviously, no matter how you classify the markets, and no matter how many classifications you use, whether it's 24, 48, or 64 like we do, you're going to have some conditions that's just organically more dominant than others, right? So that's normal, right? But you still want, even in the less dominant structures, to have good trade frequency historically. And so again, to show how this just how the model generally behaved historically. You can see we also deploy, per position exit logic and then per entry based logic. And so an example of this would be if I expand this out. You can see the model executed 2 entries here, and we held those positions open. However, in the meantime, we also executed a couple of entries down here, right? And those executed, with a profitable result. So, per entry based profit targets help mitigate open position risk by securing and closing a certain amount of profit there, right? And so that is another aspect that we do to kind of improve overall outcome consistency. Instead of waiting on the average, entry, instead of waiting on close to come back above average entry price or what have you, we can execute on a per entry profit target basis. So, we have loss logic here. So we don't deploy max stops, not for our equity products. But we do have loss exit. So the model can execute a losing trade, so to speak. So, and that again is also based on market classification. So it looks at certain logic or a certain amount of movements in certain conditions to execute with the loss. Not only that, but it also measures what your current open position is, what percent of allocation you're currently allocated. So there's a lot of different underlying analytics that go into determining when we get out, whether it's to maximize return per position basis, per entry basis, to save profits, or to get out with a loss. And so, our other services are allocation models. Again, these can be purchased and or as a signal service. And so when we design these products, the allocation is really designed to serve, slightly different objectives, right? Someone that's maybe a little less involved, more compared probably towards buy and hold, but that doesn't mean that they have to be that way. And, I'm going to show you a result of the same allocation model applied to the same asset, but in 4 different unique ways. And this is just to show the versatility of these products, right? And so as you can see down here, here is a variant that has, a longer term position hold, right? A common theme. We always try to exploit value, whether it's reverting, random, and or cyclical, right? We want to, again, diversify the factors that produce outcome. In essence, really, it's like, if you were a massive hedge fund and you had a $1 billion hedge fund, instead of allocating to 10 different strategies that's applied to SPY or QQQ and different accounts, we kind of shrink that down into a single strategy, so to speak, right? So we're deploying diversification, but within a single strategy structure, right? And so as you can see here, we're exploiting, more cyclical value here. But again, the same model applied 4 different unique ways. It doesn't have to be the case. Just by applying, maybe a per entry profit target, or maybe you want to scale out of positions. You want to scale in and you want to scale out. We also have that structure as an option there. So again, here's some hypothetical, simulations from that. And again, the reason why you see such high trade frequency is that allocation models are not designed to identify the optimal entry and exit prices, right? They are designed to only identify the optimal allocation at any given time, condition, etc. So that's what you're seeing is, you have a higher percent time in market, more comparable probably towards a buy and hold. However, when you allow positions to close a little more quickly, and then with a compounding money management, you can see that you get a benefit from that, kind of deploying that structure, so to speak. And so, but again, it's very simple. So, the logic here updates once a day at market close, and it's just a percentage, right? And so, an example of that, let's see, where is that on our website? And so an example of that, for instance, an allocation yesterday for SPY was 8%. Today it's 15%. Action today, buy 7%, right? So whatever you have applied to SPY, maybe you have a 100K portfolio and you've applied, 10,000 to SPY, right? So, you would buy 7K worth of, whatever, close divide, you would just plug that in. A lot of trading platforms have a dollar input, right? And whether if you want to use margin or not, that's completely, you have complete discretion whether you want to run these models as a semi-automated basis, as a fully automated basis, and or within your discretionary analytics as a discretionary strategy, within your analytics or confirmation process, right? So you have the choice. So when we deliver these signals to you via email structure, they're super simple to follow. Or if you would purchase the model and deploy it on your own, this is what, you have. So they're really easy to follow, right? Whether it's they can, even the allocation models themselves, technically, they're also, I've designed them to also be a systematic strategy, but, you know, so you have the option to complete discretion. You also have the ability to customize them if you wish, again, if you purchase them. So you can apply this model to other assets. Here again is the same model applied to SPY, right? And so here's a simulated hypothetical. And again, surprisingly, this model is not identifying has zero logic that identifies optimal entry prices, right? So we're not classifying the market specifically for that reason, right? To say, well, if it's in classification 3, I want to look at, close of, the average low of the past 10 days minus a certain percentage of open minus low, right? There's none of that, right? It's just basically close limit logic on the entry side. And so surprisingly, whenever you have an intelligent allocation model, combine that with multiple entries, you can get, the framework there is, to nurture positive outcome. And so here again is the same model variant applied to SPY. Again, it's just a different variant. And so again, here's the allocation model, just more simulated examples applied to XLP, RSP, IWM, AT&T even. AT&T actually, for reverting, for value-based strategies, works extremely well, we've found. Surprisingly, AT&T is one of the most reverting individual stocks, not to mention it has a pretty decent dividend. So, for deploying buy and hold, or for deploying market timing strategies that maybe have slightly higher position holds, would actually kind of be, you would get both benefits there. And again, surprising that you're not deploying any logic to identify optimal entry and exit prices. It's literally just the main logic is really centered and focused around finding the optimal allocation percentage on a per entry, per condition, or classification basis. And so, again, here is an example of one of our processes that we follow whenever we're designing a strategy. We take things one classification at a time, and we layer it in, and we actually want to start with high volatility conditions first, or high value conditions first, right? And because we want those to be the most efficient. For instance, if you're starting with extremely bullish conditions first, that you got to be careful within your testing process, because especially if the markets has a strong linear bias, the data or the result, depending on your fitness function, will always want to lean a certain way. So what we start with really is the most extreme bearish conditions first, or volatile conditions first. So as you can see, this is just a single classification, right? And so how we test it is with the very basic exit logic, because we want to test the efficiency of the entry logic, right? Our entry values, our entry calculations or conditions, etc. We don't want to throw everything at it, because more then you're really testing the ability of your exit intellect or exit logic or models, to force a bad entry model to be a good entry model, right? So every structure that we implement is designed to mitigate the risk of if the previous structure kind of fails, right? So again, here is an example of that. So our exit logic is extremely basic, right? So let's just go through and activate a profit target now, right? So this is just a profit target applied to a per entry based profit target that's applied to this specific entry model, right? So now you see a little bit more efficiency, right? And so now we can even adjust that and say, okay, historically, is 5.2 the best, or 850? Let's try that one, right? Okay, so again, you still see some benefits, right? And high volatility. This trade didn't work out where previously it had two profitable trades. Okay, but then what you got to say is, well, when we combine this structure with multiple entries, right? So if we're entering here, and again, we enter here, this trade right here is still going to be a profitable position, even if that exit continues for the entire position, right? So you have to think of it in context as well. But again, when we design a complete systematic strategy, everything is really designed to work in unison, under the expectation that other structures are going to fail, right? So that way we want the best entry efficiency possible, then the best additional entry efficiency possible, and then the best allocation efficiency possible, and then your exit logic, etc., right? So everything really kind of molds together, works in unison to nurture positive outcome, to really mitigate the risk. That randomness is somewhat stochastic in nature. So multiple entries even offers the benefit to even exploit that to a certain degree. And so that's a reason why multiple entries is really combined with market classification are two of our two main framework structures that we deploy, that we found in our research, that really mitigates a lot of the risks that other firms, other quant concepts or models come to, historically speaking. And so that's really what we want to avoid. And so, again, let me see. Here's again the visual basic of some classification. Now we do design and offer some analytic structures. These are market classification analytics, believe it or not. And so, let me see. And so these are actually designed to serve very specific, uh, purposes, right? And so let's say, for instance, that you want to design a strategy that exploits various forms of volatility, right? So first thing that you have to do is you have to classify different variations of volatility. You have to classify different volatility conditions, right? And so that's really what these analytics are designed for, or momentum, right? It doesn't matter. So they're designed to break things down into very specific forms of analytics. So these really classify 64 different sub-variations, I guess you could say, of volatility, of momentum, reverting behaviors, overbought, oversold, et cetera, right? So they're seek to serve a very specific purpose for those who want to go down the discretionary trading route, and really choose to deploy indications that serve very specific purposes. So they're also programmed to be extremely versatile. So every client has access to the code itself, the input, so you can change everything that you want. You can take the concepts, the analytics, the proprietary analytics functions that we've incorporated into your own strategies. Again, that is for those who want to be a little more involved. Some people don't want to be more involved. Some people just want something that's super easy to learn, super streamlined to deploy, very simple, very direct. And maybe that's not your route. Maybe something, receiving a strategy that's already designed, more plug and play, with still the ability to go in and tune if you want, to certain preferences, maybe more return potential, or mitigate more, or tune more for a lower risk profile, et cetera. And so, we really want to kind of serve the needs of a wide and ranging group of clients, right? And so again, all of our products are whether it's a purchased product and or a monthly subscription signal service, whether it's a quantitative strategy or an allocation model, is really designed to be implemented, it's designed for clients to leverage, really our years of research to deploy something that's intelligent, that's adaptive, but, in a very quick, simple, direct manner. And, we also have, packages. So we realize that, some people's just not going to trade or have an interest in a certain market. So for instance, our software packages, products that are purchased, we include different discount levels for however many markets that you want. And again, while we deliver a fully developed version to you, you also have access to the strategy, to the inputs. So you can apply to other markets if you wish, right? So you have that ability should you purchase it, right? And so here's our ETF products. You can purchase a single strategy. You can choose which asset, which ETF, and we really focus on the majors. So we're, a lot of the major indexes, sectors, et cetera. So SPY, equal weighted SPY, dividend SPY, QQQ, Dow, IWM, IWF, XLK, XLE, a lot of the spiders, and then TLT and GLD. I don't know if that's listed on here or not. No, it's not, but TLT and GLD as well. And then, those can be deployed again as a signal service and or as a product that's purchased, right? So we deliver the signal to you via email. The same is for our allocation model. So no matter if it's an allocation model or if it's a quantitative strategy, both the signals are delivered at after the close of every day, right? So you just have to check your email once a day, and it has the logic there. Whether the per entry profit targets, the the entry, prices, target prices, et cetera. So whether it's an initial entry, additional entry, all the information for you is there in a very simple, direct manner for you to follow and employ in a timely manner, and input those values into your platform in a quick manner. So, our signal services, again, you can choose, it's basically split up into our ETF signal service and our stock signal service. And so for our quantitative strategies, and then the same thing for our allocation service, right? So all of our ETFs, basically, a lot of value here. So in essence, for our ETF signal service, in essence, you're getting, 20 strategies, right? You're getting 20 strategies for 20 different markets. For our stock signal package, we offer, we really focus on a lot of the main large caps, large cap blue chip dividend type stocks. Then we have a few growth stocks in there as well, that we focus on. And so let me see if it'll. Okay, so here's a current list of available stocks. And we also offer customization services. So depending on what level of client you are, we can design a completely customized product. We can tune one of our current products, our models, for certain assets. We can also design a completely customized portfolio. And so those are, again, for certain type of clients that we can offer our customization services, of which many conversations are had to get to know each other, certain preferences, etc., and really customize and tune to very specific goals, preferences, etc. And so that really encompass our full arsenal of concepts to deploy in a manner that best, that best serves each individual client as far as our customization services go. But here's our list of individual stocks that we offer, both as quantitative strategies as well as our allocation models. So again, everything is offered either as a purchase product and or um, a monthly subscription signal service, right? And so no matter if it's deployed on your trading platform, or an email structure, everything can be followed in a very simple, easy to follow. That way, we understand that these concepts can be extremely complex to people that's really not exposed to them on a daily basis, right? So when I'm talking to another quant strategist, we can speak the lingo, and not fall asleep. But for some people, they're just not, they just want something that's kind of already put together for them. And so that's really what we try to do. So they without sacrificing quality, intellect, adaptability, the insightfulness, the ability to understand that markets are in a constant state of change, and that randomness, it can really have a negative impact, especially on single entry concepts. But the market conditions really changed dramatically in the late 90s. A lot of it was really due to market access, right? You had a lot, a much easier path to retail clients, trading the markets. And so, the days of trading a simple moving average, cross strategy and trending concepts are kind of over. You saw the correlation to those, the performance correlation to those that have continued to decline. And so that's one reason, again, why we really want to stick with value concepts, and diversify, whether it's random, reverting, or cyclical. And because also those are based kind of on a fundamental justification. The markets that we are trading are fundamentally justified. They're behaviorally justified as well. For instance, Walmart does good in a good economy because people go there and they buy, computers and laptops, and they get their cars serviced, etc. And Walmart goes decent in a bad economy because people go there and they buy more clothes, more bulk foods, especially. And so their correlation to the SPY or the RSP detaches in systemic risk environments. So we use correlation analytics like that to determine what kind of model or what type of value that we should aim to exploit, right? And so you know again, if you have any questions, please feel free to reach out. And then, this is kind of just a brief introduction, into our concepts, products, services, etc. But if you'd like to know more, you can just YouTube search Brian Miller Trader and a few of the other podcasts in interviews that I've been a part of will pop up, and you're more than welcome to listen to those sometime if you're having trouble falling asleep. So, um, but again, every structure, the most important things with us is that, we really seek to mitigate a lot of the associated risks that are associated with quantitative strategies, right? And it really begins with understanding, classifying the market in a certain condition, understanding where we are within that classification, where we came from, to maybe get a better handle or predictive value of where we're going. Design something that's market condition specific, right? So that when the market conditions change, our outcome isn't dependent on any single condition or on any single anything of a single nature, right? And then allowing multiple entries per position, right? And so that creates the framework for us, that if we're not right on that initial entry, that we can still produce a positive result in that position, right? And so it also creates the framework again for, more intelligent allocation models. So everything really reverts to market classification, additional entries, and then trying. But we really feel that a lot of strategies, a lot of developers, a lot of quant developers and strategists really spend a lot of time, focused on finding, the absolute optimal entry strategies, right? And to be honest with you, I really feel that, intelligent allocation concepts or models are an area that is significantly, you know, underdeveloped, really not pursued, really, especially factoring in their potential impact on both, improving a trade's probability of positive outcome, increasing the amount of profitability on that trade, and or reducing the risk of failure on a per trade or per position basis, right? And so when you look at the potential impact of an intelligent allocation model, it's a critical structure. It should be within a quote unquote complete quantitative solution. And so we really worked hard to look at it in a matter of phases, and to, like a trifecta, if you will, that if any one part goes down, we still have other aspects within that solution, within that strategy or structure, that will still nurture a positive result and or mitigate the risk of loss, right? Now, again, we're not, concepts are not infallible. You're going to have losing trades, you're going to have drawdowns. But I think when you can deploy structures that work in unison, all designed really to increase the per trade probability, when you combine that over a long period of time, it can have a pretty dramatic impact on results, right? And again, it creates a lot of versatility too within your exit logic. You don't have to pursue a large percent return per trade to achieve, exponential growth. As you can see here, some trades that we take are kind of small. Maybe, when you're using market classification, that's the benefit. You can say, well, what's the optimal exit logic to pursue in classification 2, in classification 20 or 64, right? Maybe it's a percentage of volatility. Maybe it's 10% of volatility in one. Maybe it's 1.618% of volatility in another, right? And so, we try to implement things or analytics that have a fundamental or technical justification, right? Such as look back periods that are based on what, a lot of banks, a lot of, institutional traders and funds use, such as 250, et cetera. So, and then Fibonacci, like if we're using a multiplier or a percentage, we try to stick with, a certain percentage that's also heavily used within the community. And so we try to have a fundamental or a technical justification for everything that we implement. Like for instance, if we are subtracting, something from close price to determine what the optimal entry target is, right? Maybe it's the open minus low. What's the average open minus low of when classification 1 occurs, right? So if our condition logic is true for our entry target, and we want a very specific entry price, right? What is the average open minus low whenever that condition occurs? So now we're trying to be extremely precise with our entry target to squeeze out as much efficiency from that model, from that entry as possible. And so maybe it's only going to improve, the profitability by, a couple ticks, maybe 5 ticks or 6 ticks. No matter what it is, it's still, that over time, those little small subtle improvements, each entry, each exit basis, those add up to be, a significant improvement compared to something that's just set in nature, throwing a stone into a river and expecting it to mimic its flow. And so really everything is about, the strength of adaptation. And so, but again, if you have any questions, please feel free to reach out. We really maintain an open door policy here. It's to our benefit that our clients are successful with our products and services. So we really strive hard, to provide a level of customer service that's equal to or greater than the amount of time and effort that we put into actually designing the product, right? And so, it's to the betterment of our business that our clients are successful. So, we maintain an open door policy. Anytime you have any questions, please feel free to reach out. And again, no matter if it's a purchased product or if it's a signal service, we'll be there for you to help you with the setup, with familiarization, and to answer any questions regarding any of our products, services, customization services, etc. So if anybody has any questions, you're free to shoot. Oh, I should also add that we our allocation sciences line of allocation models. We have the revolution, evolutionary, which are designed for equity products, and then we actually have the revolutionary FXC. So those are the revolutionary FXC variant is specifically designed for FX and cryptocurrency market. So it's an allocation model that's specifically designed. It's long only, but when you look at applying that over different pairs, those are kind of like hedging strategies, so to speak. So you can apply that, even though they're long only, they're applied to the different pairs that can mitigate that risk. But the allocate or the revolutionary FXC is the one that's designed specifically for FX and cryptocurrency. Alrighty, guys. Thank you.